If you're waiting for a letter that says, "We are confiscating your money," you're watching the wrong movie. That's not how modern wealth grabs work. In 1933, the US government didn't send out a memo labeled, "We're stealing your gold." They signed Executive Order 6102 and made it a crime to keep more than a small handful of gold coins. Today, the same fear is back in a new form. People are asking, are they about to do the same thing to Bitcoin? With Trump's new strategic Bitcoin reserve and debt numbers that look like a bad joke, it's easy to panic and say 1933 is back. In this video, we're going to separate history from hype. We'll look at what actually happened with gold in 1933, what Trump's Bitcoin orders really say, how likely a 1933-style Bitcoin ban actually is, and most importantly, how to position yourself without going full tinfoil. This is not financial, legal, or tax advice. It's pattern recognition, plus a plan for normal people who don't have time to live on finance Twitter. If you spend 5 minutes on financial YouTube, you'll hear some version of the same story. They stole 40% of Americans' wealth in 1933. They're going to steal your Bitcoin next. There is a real story underneath that. In 1933, President Franklin Roosevelt signed Executive Order 6102. It restricted private gold ownership and forced Americans to turn in most of their gold at $20.67 per ounce. On paper, the penalties went up to $10,000 in fines and 10 years in prison. Then, in 1934, Congress passed the Gold Reserve Act. That law moved the gold into the Treasury and reset the official price to $35 per ounce. That devalued the dollar against gold and instantly increased the paper value of the government's gold reserves by billions. Now fast forward. In January 2025, President Trump signed Executive Order 14178. It's called Strengthening American Leadership in Digital Financial Technology, and it set a pro-crypto policy tone. In March 2025, he signed another order that established a strategic Bitcoin reserve and a U.S. digital asset stockpile, built from Bitcoin and other assets the government already seized in law enforcement cases. Put that next to more than $37 trillion in U.S. debt and ballooning interest costs. And you can see why people connect the dots in the spiciest way possible. Gold in 1933 equals Bitcoin in 2027. Confiscation and revaluation are guaranteed. So let's slow it down and actually walk through the two sides. What did 6102 really do? What do the 2025 Bitcoin orders actually do? And where does reality end and YouTube fan fiction begin? What really happened in 1933? To understand the fear, you have to understand the original play. In 1933, the United States was in the middle of the Great Depression. Roughly a quarter of the workforce was unemployed. Thousands of banks had failed, and the dollar was on a gold standard. Every dollar was supposed to be convertible to gold at $20.67 per ounce. People didn't trust banks, so they did two things. They pulled cash out of their accounts, and they asked for gold, not paper. That drained the banking system of gold reserves. Under the gold standard, the Federal Reserve couldn't just print more dollars without enough gold backing them. The money supply shrank, prices fell, wages fell, debt got harder to pay. The system was spiraling in the wrong direction. Enter Executive Order 6102. Here's the simple version. The order made it illegal to hoard gold coins, bullion, and gold certificates above a small personal amount, roughly $100 in face value, which worked out to about 5 ounces of gold. Americans had to turn in their excess gold to a bank or a Federal Reserve branch by May 1st, 1933, in exchange for $20.67 per ounce, the official price that had been in place since 1900. There were exceptions. You could keep jewelry. Businesses like dentists and jewelers could keep gold for their work. You could keep a small personal amount and rare collector coins. But the message was clear. If you were holding gold as a form of savings, you were expected to hand it over. On paper, the penalty for willfully violating the order was severe, up to a $10,000 fine, which was an enormous sum at the time, and up to 10 years in prison, backed by expanded emergency powers. Here's the nuance most doom channels skip. Most people did comply because they trusted the government and believed it was temporary. Enforcement was real, but it wasn't a nationwide door-to-door raid. There were some high-profile prosecutions, but not millions of people dragged off for gold coins under the mattress. Then came the second punch. In January 1934, Congress passed the Gold Reserve Act. That law transferred the nation's monetary gold to the Treasury. It gave the president the power to change the gold value of the dollar. And Roosevelt immediately used that power. He reset the official gold price to $35 per ounce instead of $20.67. That did two big things at once. First, the paper value of the government's gold reserves jumped by roughly 69%. Billions of dollars of new balance sheet value appeared with a stroke of the pen. Second, the dollar lost around 40% of its value versus gold. That effectively reduced the real burden of dollar-denominated debts. For the government, it was a very effective balance sheet fix. For regular citizens, it was brutal. If you turned in gold at $20.67, you watched it revalued to $35. You couldn't legally buy it back as a store of wealth, and private ownership of bullion would stay restricted until 1974. So, the core of the 1933 playbook was simple. Restrict ownership, force conversion at an official price, revalue once the gold is in government hands. Use the devalued currency to shrink the real weight of the debt. That is the historical foundation of the "they stole your wealth" story. It's not a myth, it's documented. If you appreciate someone actually walking through what happened instead of just yelling, "they stole 40% of your wealth," in all caps, consider subscribing. That's the whole point of this channel. Now, let's look at what 2025 actually says. In 2025, there are two big crypto moves people lump together. The first is Executive Order 14178. That's the one called Strengthening American Leadership in Digital Financial Technology. It was signed on January 23, 2025. It sets a broad policy that the United States should support the responsible growth of digital assets, blockchains, and related technology. It talks about promoting innovation, improving regulatory clarity, and rolling back some of the prior administration's more hostile frameworks. The second is Executive Order 14233. That one was signed on March 6, 2025. It establishes a strategic Bitcoin reserve and a U.S. digital asset stockpile. Here's what that actually means. The strategic Bitcoin reserve is a pool of Bitcoin the government already owns. It comes from criminal forfeitures, civil penalties, and similar law enforcement actions. The digital asset stockpile is the same idea for other seized digital assets. Agencies are ordered to inventory their government-owned Bitcoin and digital assets, transfer them into centralized custody, and then come up with budget-neutral strategies to manage and, if possible, expand those holdings. In plain English, the government is stockpiling Bitcoin it already seized. It is not ordering you to sell your Bitcoin. It is framing Bitcoin as a strategic reserve asset, like digital Fort Knox. But it does not contain language that forces private citizens to hand over their coins. That shift still matters. It is the first time the U.S. has formally treated Bitcoin as a strategic reserve asset, in the same mental category as gold reserves or the Strategic Petroleum Reserve. But is this literally Executive Order 6102 with a new label? No, not in the text. We might see future policy proposals that build on this direction, but if you actually read the orders, right now we're keeping seized Bitcoin and may strategically manage it, not every citizen must surrender Bitcoin at an official price within 30 days. So the honest answer so far is this. The 1933 analogy is directionally relevant. Governments under debt stress will look for levers. But claiming the Bitcoin reserve order is 6102 version 2.0 is an exaggeration. The language and legal structure are very different. Let's zoom out and look at incentives and tools. What's similar to 1933? The government has a massive debt problem. There is a real political incentive to inflate away part of that debt, rather than openly default or slash spending. And hard assets like gold, Bitcoin, real estate, and commodities are natural targets whenever people start talking about wealth taxes, windfall taxes, or emergency measures. What's different? First, there is no gold standard. In 1933, the gold peg literally limited how much money could be created. Breaking that link was the whole point. Today, the dollar is already a fiat currency. There is no gold or Bitcoin convertibility clause to destroy. Second, the financial system is far more complex. We have trillions in derivatives, global capital flows, and foreign holders of treasuries. Any sudden confiscation move now would have massive second-order effects. Third, the political and legal environment is different. There are more layers of resistance, courts, advocacy groups, a fragmented media landscape that doesn't just repeat one narrative. And fourth, governments today have quieter tools that work very well. They can run inflation a bit above interest rates for years, which slowly transfers wealth from savers to borrowers. They can change tax policy and target the gains in certain assets. They can tighten regulation and surveillance without outright banning ownership. They can create incentives that herd you into assets they control more tightly, like certain ETFs, bank products, or retirement accounts. Here's the turning point most people miss. This is where the conversation usually goes off the rails. Some people decide they'll definitely ban Bitcoin and take everything, so nothing I do matters. Others decide they'd never dare, so I can ignore policy risk completely. Both of those are fantasy. The truth in the middle is uglier and more useful. Governments have a lot of levers, and you don't get to pick which one they pull. Your job is not to guess the exact play. Your job is to stop being fragile to any single one. Could there be a 1933-style Bitcoin order one day that says, you must sell holdings above a threshold to the Treasury at an official price? In an extreme crisis scenario, it's not impossible. Emergency powers are broad, and the national security framing leaves the door open to tougher measures. But from a cold strategic perspective, it is not the only lever, and it's not obviously the first lever. A more realistic sequence looks boring. More reporting and tax enforcement on crypto. Preferential treatment for regulated products like ETFs and custodial accounts. Special taxes or stability levies on certain kinds of gains. And a quiet use of inflation and interest rate policy to shrink the real value of the debt. That's more friction and skimming than open confiscation. This matters for your decisions, because acting as if a 1933-style ban is guaranteed pushes people into dumb extremes. 0% Bitcoin because they'll just ban it, or 100% off-grid doom prep with no income and no liquidity. Both are bad plans. So if you strip away the drama, the real question is simple. How do you build a balance sheet that doesn't get wrecked if the government uses any of its tools, not just the 1933 cosplay version? Here's a practical way to think about it. First, don't let custody risk be your blind spot. Whatever happens with policy, one thing is obvious. Bitcoin and other crypto held on big. KYC exchanges are visible, centralized, and easy to regulate. Assets held through ETFs and custodians are one legal change away from being treated differently than assets you control directly. That doesn't mean you should never use an exchange. It means you should not assume that a number on an app screen is the same thing as holding the asset yourself. You need to understand who controls the private keys and what legal obligations they have. If you're going to hold meaningful crypto, learn basic self-custody with a reputable hardware wallet. Spread the risk so your entire stack isn't under one company, one jurisdiction, and one login. No drama, just not putting your future in a single forgot password link. Second, avoid single asset religion. The 1933 fear story pushes people into binary thinking. Bitcoin is our only hope. I'm all in on one side. They'll ban Bitcoin, so I want nothing to do with it on the other. Both ignore the obvious. Governments can target anything: cash, bonds, real estate, retirement accounts. They just use different tools for each. So instead of asking gold or Bitcoin or stocks, ask a better question. If this one piece of my portfolio gets taxed harder, inflated away, or regulated, do I still have other legs to stand on? Picture a very normal setup. 2 incomes. A mortgage, most of the family's net worth sitting inside a 401k and a couple of IRAs. A small brokerage account with some index funds, maybe a few $1,000s worth of crypto on a big exchange. Run that through a quiet wealth transfer scenario. Inflation runs a few points above wage growth. Tax rules on retirement accounts tighten. New reporting rules and fees hit certain investments. Crypto on regulated platforms gets more restrictions and higher friction. Nothing in that list requires a 1933-style confiscation to quietly strip 30 to 40% of their real purchasing power over a decade. That's why diversification across different types of assets matters more than winning arguments about a single ticker. In practice, that usually looks like a mix: some cash and liquidity for flexibility and emergencies. Some productive assets like business income, skills, or real estate that actually cash flows. Some hard or harder assets like a bit of gold, a bit of Bitcoin, maybe other commodities, and some plain vanilla broad equity exposure, especially if you don't want to live in your brokerage account. You are not trying to guess the exact policy move. You are trying to make sure no single move can wipe you out. Third, respect tax and legal reality. You'll hear creators flirt with "just say you lost your wallet" or similar games. That is not where we're going on this channel. If your strategy requires lying on legal forms, hoping audits never happen, or telling yourself they could never enforce that, you're not hedging. You're gambling your future freedom on a story you like. Better questions sound like this: if they raise capital gains tax rates on crypto, am I still comfortable with my allocation? If they add new reporting for offshore or custodied assets, am I structured cleanly enough to sleep at night? The goal is to position yourself so you can adapt to new rules without having to choose between financial ruin and breaking the law. Finally, learn the real playbook of quiet wealth transfer. The 1933 story is loud and dramatic. The tools that are more likely now are slower and quieter. Inflation that runs ahead of your wage growth. Interest rates held below inflation after a crisis. Tax changes that sound targeted but quietly hit a lot of people. And constant nudging into assets that are easier for policymakers to manage. The antidote is not one magic asset. It's keeping your earning power strong, keeping your debt manageable, owning some assets that benefit from inflation, and not letting any single government lever decide your entire outcome. So let's come back to the original question. Will the government ban Bitcoin the way it banned gold in 1933? The honest answer is this. The incentives that drove 1933, too much debt and too little flexibility, absolutely exist again. The exact 1933 play, an outright ban, forced surrender, then overnight revaluation, is a tail risk scenario, not a guaranteed script. And the current strategic Bitcoin reserve orders are more about centralizing and preserving government-owned Bitcoin than confiscating yours, at least for now. If you build your life around confiscation is impossible, you're naive. If you build your life around they will definitely ban Bitcoin by a specific year, you're still naive, just in the opposite direction. In both cases, you've traded one story you can't prove for another. The only sane move is to stop anchoring your entire future on any single government move and start building a balance sheet that can survive more than one scenario. In the next video, we're going to take this one level further and run a thought experiment. If a modern 1933 style order actually came down on Bitcoin, on gold, or even on certain retirement accounts, what would it really look like, and how would your life change day by day? Not as doom fantasy, as a stress test for your current setup. If you want the anti-doom breakdowns, where we actually read the laws, look at the history, admit what's uncertain, and then talk about what you can control, hit subscribe. Money Margins is here, so you can look at headlines like this and think, annoying? Yes. Game over? No. I know what to do next.